Hey guys, Michael Manaskanian here for our live weekly Wealth Through Real Estate group coaching call. So today we're going to go over some deal analysis, but to start off, I just wanted to highlight some pretty awesome things within our Wealth Through Real Estate community, as well as the upcoming intentional investor community starting 11/1. So let's get right into that. So just a quick reminder, here's our Wealth Through Real Estate community. There's a bunch of awesome things inside of the community, including the free real estate investing calculators. If you ever want to partner on any deals, want more information about the intentional investor, plus a bunch of training. We have an awesome community of over 650 real estate investors, action takers, people who want and understand the importance of deal analysis and mastering that. Whether you're a buyer, lender, connector, really whatever you're doing, I believe one of the key fundamentals is mastering deal analysis. So you minimize your risk and maximize your returns. We got people posting deals, people asking questions, all that good stuff. Look at this. $25 million high-end portfolio in San Francisco. Crazy. Or maybe single family homes. I don't know. Our classroom has a bunch of trainings, including some preview trainings to the intentional investor, trainings on traditional real estate investing, including a master class in deal analysis, same with creative financing, and then all of our live office hours that are recorded. And then we do our live weekly calls. This week I had to do it on Friday as opposed to Wednesday. Usually it's Wednesday at noon. I think we'll be shifting it to either Tuesdays or Thursdays, so I'll keep you up to date with that. It'll be updated on the calendar. As a preview, I just wanted to show you our intentional investor community, which is starting up. What's going to be inside is my $25,000+ veteran investor 6-part boot camp. So you're going to get access to all of that, and you're just going to pay a monthly rate. Starting out, be $500 a month. For anyone that joins in November, I'm going to make sure it's well worth the value. So you get that 25K boot camp, that 6-part boot camp. You're going to get access to a 7-part, series on getting your first deal, or maybe it's your first to your next deal. And then dozens of underwriting and deal analysis trainings, plus weekly live support. And each month that you're in, you unlock more and more things to make, your membership even more valuable. So after the first month, you get access to my ultimate creative finance calculator, which I'll be running through today to do some deal analysis. After that, we'll do a one-on-one strategy call to develop your specific roadmap. Ideally, you're doing what I did, which was buy $20 million of real estate in 2 years, leveraging little to none of your own money, and achieve financial freedom, generate tons of passive income doing that. So that's the goal for the intentional investor community, teaching you how to buy and hold real estate, minimize your risk, maximize your returns, and then ideally using little to none of your own money. Some awesome testimonials of people I've been able to help out. And as always, right, I'm a capital raiser. I lend capital out to other investors, and I also do invest passively in index funds. So let's quickly get into what is included. So if we go to the trainings, there is the 6-part veteran investor training you get access to, the blueprint to real estate investing, live deal analysis trainings, and then all the recordings between the Wealth of Real Estate community and the exclusive weekly mastermind for the intentional investor community. Inside each of these, we have part 1 is all focused on your financial freedom, going through my timeline and what worked for me, and then kind of helping you roadmap your specific timeline to financial freedom and what you want. Part 2 is all focused on mastering deal analysis. So tons of content in regards to that. 3 specific distinct parts included just inside of mastering deal analysis. In the lead generation, we go into systematizing your lead gen for deals and for capital. Then we go into the property acquisition blueprint, which is the most fundamental, systematic, step-by-step process for anyone who's buying and holding real estate, especially if they want to do it as efficiently and as effectively as I've done it. I give you the entire outline of every single thing you need to do, step by step by step by step, to continue buying great deals and to continue growing your portfolio, to achieve financial freedom and generate the wealth that you're looking for. And then I have a 4-part series just on mastering capital raising. So, there's tons of content in regards to that. And then all the systems, tools, and everything that I use, I'm giving you access to all that. My SOPs, my trainings, literally everything. So you can recreate my exact business model. And depending on how ambitious you are, you can do way more than $20 million of real estate in 2 years, or you can do less. Whatever. Financial freedom is very specific. It's whatever you really want. The types of assets you're investing in, your financial goals are very personal to you. You can do whatever you want with this information, scale it as much or as little as you want to. I just want to make all that as accessible as possible for everyone. So with that being said, please make sure to check me out on Instagram and YouTube if you're not already. So The link for Instagram, so I'm at Michael MNAT, at Michael MNAT, and then for YouTube, it's at Intentional Investor. So stick around there if you want to stay connected. So I'm going to open this up now to our live office hours and deal analysis. So any particular questions I can help answer for anyone?
Yeah, Michael, if there's a way for you to potentially help me on one property I'm looking at.
Sure, yeah. Can you just give me some, what are we talking about here? What's this property?
Yeah, you bet. So my son goes to school in Missoula, Montana.
Mhm.
The place he stays at, the owner is trying to sell it, and she is looking to get 989 on the property. She's got $95,000 left on the loan, so a lot of equity built in. The loan's at 3.5%. It's a good property. It's an older one. It's unique as far as its appearance. It's not a typical house. It's a lot of pine boarding on the inside. But the potential reason this may not work out is because she's looking to do a 1031 exchange for another property to sell this to
Mhm.
start a Jellystone campground in another state.
And for those of us who don't know what Jellystone is, sounds like Yellowstone, but in a funny way,
Yeah,
but I don't
yeah,
think.
it's if you think if I know it as best as I can remember, like oh boy, Yogi Bear and Honey Boo Boo or something like that, who is his Boo Boo Bear and Yogi, they are it's kind of the mascots of it. So it's a family orientated RV park is really
Oh,
what
very
she's
cool. So
looking
it's like
to
a
do.
franchise RV park kind of deal.
Correct.
I see.
Correct.
All right, let's pull up this property on PropStream. So let me start off with PropStream and see what's there. So what is the sell like? So they're willing to sell it. They're open to selling it. Why are they willing to sell it? Like what is she looking to accomplish? Like, are you okay? Let me ask you this. Are you hoping to structure this deal creatively? If so, like what's her motivation that you think creative financing might be viable?
Yeah. To be honest, and I've had one phone call with her and some texts going back and forth. I'm not sure she's going to be open to creative financing, because she wants to cash out to take that money to invest in this next property. So, um, if we could find something on the back end of a buyer to help her do that, maybe it would be different. What she told me is the play on this property is to, once they're done with their lease, if they're not going to be bought out, the play on the property is knock down the house that's there and build two houses on it, because it does fit that lot layout for two houses. And she knows that from as far as the city, and a couple of houses just east, I think, of it. They did that a few years ago. So she
Mhm.
says that's the big play, but there's a lot of a sit and hold on that. So basically this house and garage are right in the middle of the front and back of the property.
Okay. Okay. Yeah, I see. So they have potential opportunity to whether they can sell it to then take that money and go for the RV park route, or if
Yeah,
they have to sit on it, they can just expand and make this a more profitable investment. I'm going to
correct.
tell you
She's
now,
yeah,
based on that one conversation you had, I don't see like a motivation unless
yeah,
the seller, like, because she could just continue making more money on this property. Doesn't sound like she wants to stop making that monthly income. So maybe you can make it like mailbox money for her. She's the lender. It looks like she has very to little debt on this property. What is she looking to sell it at? Do you know roughly? And I'm going to
yeah,
open the Ultimate Creative Finance calculator as
yeah.
well.
It's 989,000. And again, she owes 95,000 left on the loan of that at 3.5% on that loan.
Okay, so it's a 5 bed. What did I say on PropStream? 5 bed, two bath. We'll
Yep.
skip the square footage for now. We're not going to worry about comping it. Let's just see what the monthly debt payments are. And let's go the traditional route first, because I don't see this being viable for creative unless we get some more motivation from her. Or maybe she tries to sell traditionally and it's not working out. So then she's open to selling creatively at that price.
Yeah.
Sounds like she has a very specific price in mind. Do you know how she got to that price?
Yeah, I asked her and she said it's worth $1 million because of the potential of the property. She apparently has been a realtor for a long time, not very active in what she's doing with that. She owns four or five other properties in the area. So I think she's banking that off of the property that's a couple houses down, of the future, that if she were to stay, she would knock down the house and build two on it.
Okay. Yeah, that's going to cost her a lot of money. So maybe she could do that if she does a cash out refinance, pulls money out. and then goes to that strategy, but it's going to cost a lot of money to tear down and then build, right? Tear
Yeah,
it all down and then build too. I mean,
correct.
that's not an easy thing for easier said than done, I guess. And the potential is great, but I know in like for example in San Diego, we pay a lot of money for lots where we can build multi-units. I don't know a lot about Missoula, Montana, but I assume it's not like I assume there's more enough land if someone were to build something. The land itself isn't extremely valuable, but that's just an assumption.
Yeah, it's a college town, but a smaller college town. And there is, property in and around the area, but it's also, mountain state. So there is property that's being built and it is all multifamily that's going up.
Yeah, exactly. Like it's very, I would assume it's because it's in Montana, because of the population size, I would assume it's fairly easy to build if someone needed to. The value of the land and the potential to build two on one lot, like it's not as valuable as if it was like a major city that was like tapped out on the amount of available
Correct.
land to build on.
I would agree.
Very small population. I mean, it's not tiny, right? I just like over 30K, but it's ideally I like over 300,000, but it's not anything huge. Okay, so we've got some info there. What was the price again that she's looking for?
989.
Okay, so just for anyone who's doing this, you can actually utilize the creative finance calculator for traditional financing. I have a separate conventional finance calculator, but really there's no difference between a new loan and a seller finance loan. It's the same exact thing. So we just recreate it by eliminating anything in relation to sub two. Well, how much you say her loan amount is?
95,000.
And do you know roughly what the payment is on that 95,000?
Roughly. I thought she said 1,800, but it might have been 900. I guess I didn't write that down. I don't know what I did with that, but I know she's
So,
making her rent is 4,250.
roughly how much you say for the payment?
I'm going to say 1,800, but I think that's low.
1,800. Okay, so let's just recreate. Like, I don't like to take over a sub two loan that's near the end of its like loan amount. It's great because every payment is going towards more towards principal, but that $90,000 a loan that you're taking over, you still have to account for the rest of her equity somehow. You have to make payments on the full sub two loan because that's based on the original loan amount. The original loan amount is where the monthly payment amount comes from. But when you're taking over later, you're paying an outsized amount of monthly payment for that loan amount. So just to show what that looks like numerically, if her loan is 3.5% and it's 30-year loan, let's see and we're going to assume some of this, is, do you know how much of it is insurance and taxes, or is this exclusive of insurance and taxes?
She told me that was everything.
Okay. So we'll just take off like $100 a month for insurance, or maybe 120 a month equals this amount minus 120 plus, let's just look up PropStream and get a cheat code for the taxes. 6515. Oh, okay. And it's going to go up even. Well, it looks like it might be the same. So 6515 plus 6515 divided by 12. So we're taking the property tax, dividing it by 12. Oops, I did plus, didn't I? Minus 6515 divided by 12. And actually, we could put that in here too. So this is very high taxes, actually. 6515 is her annual taxes. We're estimating $1,200 a month for the insurance. Let me just show you that. So our taxes and insurance right here. Let me make this a little smaller. Taxes and insurance. So what we're going to do is just see like roughly what amount of loan equates to that $1,800 a month, because you're going to pay way more. Like if this was a $90,000 loan at 3.5%, you'd be paying around $404 of monthly payment on that loan if it was a whole new loan, right? But because this was an existing loan at a much larger amount, even though you're only taking over 90,000, your payment is like 4 or 5 times that. It's like let's see. No, it's like the equivalent of 1137. Okay. So that's what it is minus tax and insurance. So wow, so they bought it for much cheaper. So actually, so the 90K that you're taking over, you're paying the equivalent of like if it was a $250,000 loan, that's roughly what your principal and interest payments are on that loan amount. That's like the reason why I don't like to take over small loan amounts, sub two, because you're paying $1,800 or 1137, excluding the taxes and insurance. You're paying the equivalent of what a $250,000 loan is at that interest rate, not the 90K, not the 90,000 you're taking over. All that's besides the point, because I think we're going to go with the route of sub two makes no sense in this scenario. Depending on if the seller's willing to carry some back, you could do it like a Morby method or a seller carryback. But let's just assume we're going to go either the traditional route or the seller finance route, and it's going to be the same. You're going to utilize a traditional loan first analysis to then reverse engineer what could work for seller finance if anything works at all. So if you're doing let's say it's a 25%, pretty standard for just like a standard investment loan, 25% down, huge down payment, 247, 250. There is zero sub two loan you're taking over. So the entirety is remainder is 741, 750, which whether you recreate as a seller finance loan or as a new loan, it's the same concept. So I don't know what average interest rates are, but for investment, so let's see. Average investment. Since I'm buying real estate, not using, leveraging creative finance, I don't even know what the standard is right now. So 7% we'll say, that's fine. Let's go that route. Say 7%, 30 years. So that monthly payment alone, even after putting $247,000, is $4,934.88. That's insane.
Yeah.
Okay.
Yeah.
So like that's already non-viable. You said what do you say the rental income is?
She's getting 4,250 a month.
And how is she getting that on a single family home?
Well, because there's 5 kids in it, 5, students.
Okay, so this is actually the 4,250. Is she covering utilities and all that for them? I would assume she
No,
is.
no, she is not.
How does that work? They just split it amongst themselves or?
Correct. Yep.
Okay. So we'll run through this and see how negative it is first, and then we'll go back and see what could we restructure it to. So she has no utilities that she's covering at all. No water, sewer, gas, electric, garbage, landscape.
I think the only thing she is, no, I'm pretty sure they're covering everything. The boys are covering everything.
So based on you, would you want to set some money aside for any additional monthly expenses outside of maintenance and reserves? Would you want to set aside anything?
Be honest,
Okay,
I'm
let's
new at this, but
no worries.
like if I look at that property when I walk in, like there's got to be stuff that needs fixing. Like the heater just had a problem, but she got it fixed in a day. I think windows could be replaced in it, but it's a college town. She doesn't care how the kids. She's very nice, and they don't care either. They're just like, hey, it's a little cold at sometimes, and it's fine in the summer. You
Does she
know,
self-manage?
yes,
Would you self-manage?
I would have my son manage it.
Okay. I
Stuff.
personally, even though we might be self-managing, I always account for property management because the
Sure.
goal is not to self-manage my assets or like they only work because we self-manage.
Yeah,
If
I
you
don't want
want,
it to
we
be
can,
a
for the sake of
job.
this example, because it's already so negative, there's really nothing we could do here. But well, there is a lot we can do here because she owns it outright. So if she's willing to do seller financing, there's a lot that we can do here. If she's not, then she's gonna have to drop this purchase price, and it's gonna have to drop like a massive amount. And I'll show you how that's automatically calculated as part of this calculator.
So
Um,
yeah, I would want to have property management in there in case something happened, but she says that they don't have problems too often.
They just set the standard 10% for long-term rental property management, although they might charge more since it's rent by the room. But let's just stick with that 10%. Vacancy of 8% translates to 1 month a year of vacancy. And then maintenance and CapEx, the standard is around 10%. 5% for maintenance, 5% for CapEx. So you have 5578 between your seller finance payment or your new loan payment, taxes and insurance, 425 or 10% of the total income towards property management, and then 18% between your vacancy, maintenance, and CapEx, or 765 a month. All right, so this is assuming you're taking out a new loan and you can't really negotiate with the bank. You can buy down credits and all that, or you can buy down your rate by buying some points, but we're going to exclude that from this example because ideally we'd go creative with this lady instead. So agent commission, is there an agent involved? Is it like listed
Yes,
on the market?
there is, and she said it would be 1% for paper.
And then would you need to put some money in to renovate this property at all
I,
as part of your entry?
I don't, you wouldn't have to, not at all. I mean, again, they signed a contract for 2 years. They're willing to live there for 2 years the way it is. I like walking into it, I would replace the oven.
Okay, I'll just set aside 1,000. That's like the minimum I put just for like
Okay.
anything basic. I mean, even if you go and touch up some minor drywall and paint, you're already at 1,000. So if you're gonna do an oven or whatever, that's easily 1,000. Closing costs, are you guys gonna split? Are you guys gonna?
I did not get that far.
All right, so I'd assume if it's a traditional sale, you're gonna split or they're gonna pay. Creative, it tends to be that the buyer's gonna pay because there just isn't enough spread. And then you're gonna have, you're gonna pay a transaction coordinator if you go creative. If not, then you don't need to account for this. LLC formation, inspection, all that good stuff. It's around 3,500. There's no wholesaler involved, correct?
Correct.
And then these are just reserves. For the time being, we could just set this at 0 for reserves for the property, like upfront reserves that you're setting aside. Since you're theoretically going to buy this using your own money for this example, we'll
Mhm.
go that route. However, if you were to raise money for it, especially prime money lender, you want to make sure that you're accounting for some reserves up front because you don't want to take over this property. Something comes up very early into the ownership. You don't have the money set aside to be able to like fix it. And
Yeah.
then you have an asset that's not performing and you have no money to resolve it. So given all this, income 4,250, expenses 5,578, and that's just the loan, taxes, and insurance. 425 for management, 765 for reserves. You're negative 2518. And I would say, and that's stretching it because your income is really somewhat disingenuous. You're like paying for the most extreme end of the income spectrum by renting it out by the room, where really you should be underwriting and analyzing deals based on their somewhat long-term rental performance, right? You don't want to overpay because the potential to rent by the room. This one's a little unique because she's already doing it and she has the leases in hand. But understanding that this is like the top end of what you're going to get. Could you raise these rates a little bit? Sure. But with a population that small, I don't know. I don't know how competitive you can be if your rent is much more over $1,000. So if you look up and
Yeah, I didn't look it on up on like Rentometer, but I know like she signed this contract. It's the same for the next year and a half, essentially, for those guys. But I would assume every year it could go up a little bit. But
well, if
I
we go
think,
for rent and then we say we're looking for a one bedroom, right? Like that's what you're competing with is a one bedroom. Right, like that's what they're getting is a bedroom or a studio. So what
yep,
is the rate for a studio in that area? Right, even a studio is better than right a rent by the room. So actually they're like right around here, aren't they?
yeah, they're more in
Here's
the
the
university
campus.
district.
So
The
there's
the
some
difference, yeah,
closer,
like
some
all of those properties that you're looking at, Michael, are much newer than hers. Like if you
is
look at,
1,500 right
yeah,
here, for example. 1,500, 300 square
oh,
foot studio. Remember,
yeah,
a studio, they're going to have probably a little bit more space and more amenities than they would with you in a rent by the room.
yeah.
I would
This
look up pad
if
split,
you
but
looked
there's
at it,
probably
it
no
probably
data.
looks like it probably looks like some of your cabins in Alaska. Like
Oh,
she has
wow.
a
Okay.
board on the inside, so it's a different property.
So what I just want to show here is if you can get studios at 900 and 850 a month, you can't really anticipate your rent by the room to be much higher than that. You know what I
Okay.
mean? Because why
Yep.
wouldn't they just rent the studio rather than renting a room, especially an outdated one, right? Like it might make sense, but for an outdated one, it doesn't make sense. Let me see if we can rent by the room on here. I don't remember if it allows you to do that. Whatever. I think we got the gist of why our cap is probably the 850. And that's pretty much in line with what she's getting is 850 per room. And that's the cap that we're seeing because at 850 and higher, people can just get a studio instead of renting by the room. And there's even much nicer ones at a much higher rate, but on the lower end, depending, based on what the condition of this property is, 850 is a very viable rental amount, especially closer to the campus right here than yours, which is over here. So let's leave it at that, 850. So there's no potential for the rent to increase, in my opinion, except for like natural price increases. But so your expenses will tend to go up in a similar amount. So let's keep going. So obviously we know this doesn't work. When it's traditional financing, that's the downfall. If this doesn't work, the only thing you can do is drop the price. There's literally nothing else you can do besides drop the price to make this work. Because I mean, you can have her cover some of the closing costs, but this, covering more of this 18,000 isn't gonna, even if you got rid of those entirely, that doesn't change this deal. It's still negative cash flow. It's slightly less negative, I guess, cash on cash return, but it's still negative cash flow. So if you were to go the traditional route, you'd have to go all the way. So that's what this calculator does for you. Tells you the various offer scenarios. If you were to reduce the price which will then reduce the down payment as well, since it's 25% of the purchase price. At what point will it become cash flow positive? Well, even if you went 40% down in price, it would still be negative cash flow, which would mean a negative cash on cash return. So even if you went down to $593,000, you would still not even be positive cash flow, let alone your goal of 10% or $100 a month in cash flow. You're not even close to that. You're not even positive, even if you bought it at 40% less price, right? The only other option then is, okay, well, if we structure it seller finance, what interest rate would you need to get to make this deal viable? That's what this does for you. This just continues dropping the interest rate at 0.5% to tell you, what the returns look like if you just continue dropping the price at 0.5% or the interest rate. What I like to do is I like to see the best case scenario. And the best case scenario, theoretically, is 0% interest rate. You can extend the term to reduce the payment or just set a flat payment amount. But in the best case scenario, it's, hey, here's the purchase price, or the most realistic best case scenarios. Here's the purchase price at 0% interest. What does that monthly look like? And that's 20, 60, 42. So in that instance, you are going to generate cash flow. You're going to generate good cash flow, $357 a month. However, the cash on cash return is extremely low because you have so much entry costs, primarily being this 25% down payment. So now in the best case scenario what your cash flow can be. You're going to now reduce your down payment, which is going to increase your loan, which is going to increase your monthly payment, but it's going to decrease your entry cost. I know that was a lot, but the overall way to increase your cash on cash return is to either increase cash flow or reduce your down payment or your entry costs, right? So the equation is cash on cash return equals annual cash flow divided by entry costs. So the only way to increase your cash on cash return is to either increase cash flow or decrease entry costs. Well, if you are going to reduce your down payment, that means your loan is higher, so your monthly payment is higher, so your cash flow is going down. But in a lot of scenarios, you have to analyze it, but in a lot of scenarios, you would need to, in a lot of scenarios, decreasing the entry, even at the cost of losing some cash flow, as long as it hits your goals, will tend to increase your cash on cash return. So let's see what that looks like. In this scenario, it's 135 and 1.6%. So let's put that. So in the scenario of 25%, 25% down, and actually I have a section for you to write all this down. I just do it there so I don't have to keep scrolling down. But you can run through various scenarios and put what it looks like in here. But let's keep running through it. And let's say, okay, what if you did 20% down? Or yeah, let's do 20% down. Does that make a substantial difference? So your cash flow went from, whoa. Something weird just happened. Oh yeah. So your cash flow went down over $100 from 357 to 219, and your cash on cash return actually went down to 1.2%. So even though your entry cost went down, the reduction in cash flow made it non-viable for you. Let's keep going. I assume that trend's going to hold, and if you drop another 5%, that's probably going to get you underneath your $100 a month of cash flow. But this is all you're doing. You're just seeing all the scenarios and then figuring out what is available potentially, and then identifying what is the highest and best use of the property, and then negotiating from that perspective. As I mentioned to most people, 95+% of properties are not good investments. And so if you drop to a 15% down payment, your entry cost dropped from whatever it was like 271,000 to 172,000, but now your cash flow went from 357 down to 82. Do we understand why that's the case? How all that plays into each other?
I'm getting there. It's not black and white yet for me.
Okay, so the gist of it is your purchase price minus your down payment is your seller finance loan. So if you increase your down payment, you have a less seller finance loan.
Got it.
Right? You're paying more upfront, so your loan is smaller. When the loan is smaller, your monthly payment is smaller, right? And then if you have a purchase price and you decrease the down payment, going from 25% down to 15% down, you are increasing your seller finance loan, increasing your monthly payment. You can't necessarily say, is that going to improve or worsen your cash on cash return unless you run the numbers? But understanding that cash on cash return equals annual cash flow divided by entry costs. So what we did was we messed with the down payment to say, what can we do? Is a reduction of down payment, even though it means a higher monthly payment, which results in lower cash flow, is that better or worse than a higher down payment with a lower monthly payment? We realized in this scenario that 25% down was actually better from a cash flow and cash on cash return perspective than going down to 15% or 10% or whatever, because soon we're going to get negative cash flow because our loan amount is so high. So
Okay.
once again, this is showing you that this purchase price is too high for this deal to work, even at this very high rental income. That's the gist of it.
Yeah.
So what
Even
we need to
in,
do is you could just hard code this and say, okay, well, what dollar amount would it need to get to? So if it was 10% or 25% or whatever, what monthly payment could you afford to make this deal work? That's the only other viable strategy if 0% isn't going to work. So we could say we could double the term to 60 years. It's going to reduce the payment. And at that point, it could work. So if she's willing to amortize it over 60 years at 0% interest and a 10% down payment, this deal would work. You generate the cash flow that you're looking for and the cash on cash return you're looking for, but you would need to come up with $123,000 and your seller has to agree to these terms, right? So
yeah,
whatever we put on paper, it doesn't mean it's going to work for the seller. And if you're not using your own money, if you're using a private money partner and you're going, let's say 50-50 split, this could work because you're getting your private money partner at least, if you're going 50-50 split, if you're going 50-50 split, they have to bring in $123,000. You're giving up 50% ownership and you're giving them a 3% preferred return. Their cash flow for the year is 8931, and their cash on cash return, 8931 divided by their 123.80 is 7.3%, which some capital partners, some private money partners are open to, including mine. If I was you, I would try to get them closer to 10%, but because your total cash on cash return is only 11%, when you split between yours and your returns and theirs, there's very little to be spread out. So if I'm bringing a private money partner, I want to see like 13% or higher cash on cash return, ideally 15% or higher. So when we split that, there's like enough for both of us to achieve what we need to. But you could do 50-50 ownership. They bring in the 123.80, give them a 5% preferred return. They get an 8.3% cash on cash return and a total return on investment of 33.3%. The return on investment isn't just the cash flow, it's the cash flow plus the debt paydown benefits, plus appreciation, plus the tax benefits with interest payments and depreciation. All of that will account for that return on investment. One thing to note is if you wanted to bring a private money lender and not split the ownership, well, that's not going to work. You're going to be negative cash flow. And it's very easy to know that because your cash on cash return is 11.5%. And that 11.5% is saying the cash flow you're generating divided by this entry cost, 123.80, is 11.5% returns. Where your private money lender is bringing you this money, $123,000 for 12% return. So you're not even generating the returns needed to be positive after you pay them, right? So it's a quick hack. If your cash on cash return is less than 12%, that means you cannot pay a private money lender 12%. If it's a private money partner and you need to split ownership, you need to make sure there's enough cash on cash return for you guys to split and get the returns that you're both looking for. And you adjust that by increasing or decreasing the ownership and cash flow percentages, as well as the preferred return. And you just get the automatic results here. All of this is automated. You just select your ownership percentage, cash flow percentage, and preferred return if you're offering that. So that's like a real easy hack. If we were able to structure the best deal in this scenario, doesn't mean the seller's going to be open to, a 10% down payment, because they could take this 10% down payment and pay off that loan that you mentioned, but then they would really have nothing to show for it besides $1,200 a month in cash flow. Does that
right.
work for them or not? It's not going to solve their problem of being able to buy was it Jelly Farm or something? The Jellystone
Jelly.
campground. It's not gonna, it's like maybe think of like SpongeBob and like, I don't know,
Yeah.
jellyfish and all that. All right. So the $1,200 payment is not going to really solve what they're looking for. And they're already generating, if their payment is 1,800 and they're making 4,200, even if they lost $1,000 a month to expenses and this and that, they're still generating over $2,000 of cash flow. Yes, they'll have to self-manage it and all that, but they're making more cash flow by just holding this asset. And if they really believe in the potential, they have the ability to cash or refinance, pull money out, further develop this property, and then rent it out even a higher amount based on this existing strategy, especially because it sounds like they're local. I don't
Yes.
see a great way for you to make this viable unless you were to take out a whole new loan, something I did for my rental cabins, take out a whole new loan, and it's going to be like a 75% loan to value. So you need to come up with a 25% down payment. After closing, then your seller does seller financing to carry back some of that to reduce your initial entry cost. That really only works if you're generating way in excess cash flow than you would be between the seller finance payment and the original loan. You can't even make it work with the original loan, let alone with adding a seller finance payment. In my opinion, this deal is extremely non-viable and it's really high risk. Whether it's your first deal or even if it's your fifth or 10th deal, because you're already maximizing the rental income, you're paying for that, and it still doesn't work. Even if you were to get the perfect terms, it's still a tough one. If you can get her to agree to 10% down, 0% interest, 60-year term, then it can make sense, right? Then you would have that cash flow and cash on cash return that you're looking for. You could theoretically raise the capital through a private money partner, and you get returns for both of you guys, but you wouldn't be able to with a private money lender. Does that provide enough clarity on what, like, my line of reasoning and my thought process when it comes to analyzing deals? Really trying to filter out what is viable and what is not viable, and then based on what is viable, how do we maximize returns? But at the end of the day, whatever we put on paper doesn't really matter unless the seller is willing to agree to it. That's why the motivation is number one with creative financing. If they're not motivated, there's no reason for them to take this. And they have plenty of alternatives that are better for them financially. The one caveat is maybe you do the 60%, 60-year term, 0% interest. Maybe then they say, okay, we'll do it at a balloon. Maybe in 5 years, you have to, you pay your $74,000 over the 5 years of monthly payments. In 5 years, you have to get a new loan to exit this property. So you're going to need to get a new loan at least $814,000 to replace his existing loan. But then you better be accurate with the value of the property, because you won't be able to refinance if that's the case. If the property really is worth, let's say, $1 million, you're going to be at around 81% loan to value already. And you're going to need right around, like, that's translating to around 19 or 18.5% equity in this property. You're going to need at least 20 to 25% equity to be able to do a refinance to pay this off, unless you bring the money from elsewhere. I'm getting really into the weeds of the exit and all that. But any questions about any of this? I see people, thank you for the comments. Investment calculator rocks. I agree. It's my calculator. It's the number one calculator I use for everything. And I advocate all my intentional investors, veteran investors, we got to use the same calculator because we speak the same language. And I've basically perfected this calculator. Doesn't mean I'm not continually improving it, but I basically perfected it for the way that we are buying deals consistently. So we're analyzing deals through all forms of deal analysis, primarily creative finance. We are making capital raising and understanding the returns for a capital partner an absolute breeze. You can analyze the deal for a longer, 30-year periods. And then if you're raising money from private money lender or private money partner, you get that analysis right away. So all I do is I say, hey, private money partner, I literally just take a screenshot of this. I did a training for the intentional investor community yesterday. But I just basically take a screenshot of this, and this is part of my pitch deck when I'm raising the capital. It shows a private money partner immediately doing a long-term rental. Here's the property breakdown. Here's the breakdown of the entry costs. Here's some of the deal terms and the acquisition. And then here's the returns. You're putting in this much, you get this ownership, this cash flow. And here's your preferred return. And here's what the returns look like, all that good stuff. So with all that being said, yeah, I see a lot of exploding head emojis. I talked a lot. I talked fast. Hopefully there's a lot of value. Oh, would you consider a balloon for the down payment to push out the cash required to a later date? If the seller is open to it, right, Mike? Like your question, would you consider a balloon for the down payment to push out the required to a later due date? I mean, that's not really a balloon for the down payment. That's more just an installment payment at some point in the future, or a balloon on the entire payment. Usually the down payment is whatever your initial cost is. If you're splitting it up over time, it's more of just an installment payment. It's different from your down payment. It's just like you're just structuring that as part of the seller financing agreement. Would you consider it? Sure. But the seller's going to have to bend over backwards to make this deal work for you based on the way that we analyze a little bit more conservatively. So I think, okay, even if we said instead of 60 years, it's 50 years. So even that doesn't work, right? You need to be at least 55. You need to be under like $1,350 a month in payment to then at least get your 10% cash on cash return. Like that's the thing. That's the main takeaway that you need to have. So if they're willing to take $1,350 or lower for the payment, this deal is viable for you. The number of term and interest rate really doesn't matter. You can adjust all that. What you need to know is what is the monthly payment, the max monthly payment you can make to make this deal viable. And it's right around that 1350 a month. Will just barely get you over a 10% cash on cash return. As I mentioned, that works pretty well if you're using your own money. If you're using someone else's money, there's not enough spread at 10% cash on cash. You need 12% or higher for a PML and ideally 13% or higher for a primary partner, at least the way that I can raise capital. And for you, it might be harder because you're newer.
Yeah. Yeah, it's for me looking at this the first time, it's pretty incredible and of course overwhelming. I'm struggling to understand how does she even think she's going to sell this property conventionally to anybody? Like
Yeah,
it
because what
doesn't
she
make
told you
sense.
was wrong, right? She put 25,000 or 25% down payment at this purchase price and interest rate of around 7%, 30-year term. So she's saying in this scenario, even if we had no money set aside for vacancy management or reserves, nothing for that. Just the seller, just the new loan payment, taxes and insurance, and your tax and insurance are going to be much higher. They have it assessed at 555,000. When you buy this property for almost $1 million, trust me, your taxes are going to go up to a comp to match that. Maybe not in this tax year, but the next tax year when they reassess, it's going to go up substantially, and you're going to pay a lot more in taxes than they are currently. Nonetheless, what she is telling you is disingenuous. Even just your rental income minus those loan payment, taxes, and insurance, you're already losing $1,300 a month, and you're putting in almost $300,000 at the lowest end just to pay the down payment, the agent commission, $1,000 for rehab, which is nothing, 1% of closing costs. None of that makes sense. Like none of this makes sense. None of these numbers make sense. There's no one who's gonna be able to do it. And I even showed you, even at 0%, it still doesn't make sense, right? Maybe the cash flow is there, but the cash on cash return isn't, even at 0%. And no bank is going to do that. So the only way she could sell it at this is if she goes creative and offers even less, even a lower payment than what a 0% at 30 years is allowing for. So yeah, that's the thing. A lot of sellers are delusional, and those that are not very motivated are especially delusional. I'm not saying they're right or wrong, but just because they're an agent, because maybe they own a rental or whatever, does not mean they know what they're talking about. That's why it's
Yeah.
up to you as the buyer, as the intentional investor, to do your due diligence and to truly understand your numbers and never take anyone's word for it. Because if and when you buy it and it fails, you can only blame yourself. Honestly, you can't blame the wholesaler, the seller, contractors. You got to take extreme ownership of every investment that you're a part of as a lender or a buyer. Regardless of what happens, it's on you. If you have that mentality, you're going to be way more successful in the long run because you know you're in control of everything. You're in control of your investment decisions and your
And,
analysis.
and and I saw that Mike said, this estimate was 750 before that. Even if the price was 750, it's still going to be, I mean, there's room, but
So even at 750 at 7% interest, you're still negative 135 cash flow. And this is once again with literally no management, vacancy, or reserve set aside for maintenance and capex. Even with 0% for all of that, you're still negative $135 of cash flow. And you're putting in almost $207,000 to then lose $135 a month in cash flow, which is not true. You will lose much more money than that because you will have vacancy in your properties. You will have maintenance and capital expenditures that you need to pay to, like when something goes wrong, you need to pay for that. And you're going to need property management unless you want to buy yourself a job. You're buying yourself a job when you're setting 0% property management. And this job is going to make you lose $135 after paying $207,000 to buy that job. That's how I think about it. You're paying $207,000 to buy a job if you're doing 0% property management, and that job is then going to lose you $135 a month. That's a shitty ass job. There's a
yeah,
lot. Go work at McDonald's, you'll make more than that. And you don't have to pay $207,000 for it.
yeah, this is good. This is definitely education for me. That is
And
for
that's
sure.
and that's why I also have this automatically do this for you, like both dropping the price to see what's viable. So you'd have to drop it to $450,000. And that's with all these zeros just to make this deal work from a cash flow and cash on cash return perspective. Your cash flow is going to be solid at that point, $1,300 a month. That's great cash flow. Um, but your cash on cash return is still only 13%. That's like the lower end of where I buy deals to then make sure that they're viable for me and my partners. If you're self-funding it, you may not need 12% or higher, but who wants to throw $207,000 to something like this? I'd rather lend that money out passively to someone else and get 15 to 20% returns on like a fix and flip or something.
Yeah. Interesting. Wow.
Any more questions, guys? Yes,
I
wasting a lot of, I'm not wasting a lot of time, Gary. Actually, that's a great point. Seems like you're wasting a lot of time to show Derek how bad this deal is. You're right. I could have done this in like 2 minutes. So there's a lot of time wasted. But what I want you all to understand are the lesson learned and my thought process, because my job when I'm analyzing like for every deal we buy, we've analyzed maybe close to 100. My job is to quickly filter out the non-viable ones like immediately. Immediately. That's where having some rules of thumb of, okay, well, if it's at, what was it like, let's just say 950. Oh, 950. Okay, at what price would it make sense? Okay, it's not going to make sense. At what interest rate would it make sense? Okay, it's not going to make sense even at 3.5%. Well, if I go best case scenario at 0%, is it viable? Well, this instance, it's somewhat viable because we don't have any of these reserves and all that. But that's what I would do. I would immediately go in and say, okay, this is what I would have done in actuality. If they said this amount, this is what I would have done. I would have had this. I would have had the rental income. No, 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 Gary, that's a great point. I think that's the whole point is our job is to really understand this process. I don't think anyone's offended. The goal of this is to show you how I filter deals. It's going to take, early on, it's going to take you 30 minutes and then 20 and then 10 to analyze deals. And then you'll be able to quickly implement some rules of thumb just to quickly move past the deals that don't make sense. Because your job is going to be to filter out the bad ones like immediately, like the obviously bad ones. So what I would have done, 950 will say 25% down, and it was like 7%. So I would have looked at this and said, okay, this is losing way too much money. I would have already known this is basically non-viable, and this is just a huge entry cost. But what I would have done is then looked here and said, okay, at what dollar amount would it make sense? Okay, if it's at a 40% reduction in price, would it make sense? No. So even if at 40% reduction, would it make sense? Cool. So like reducing price isn't going to get me there because I can reduce the price to $0, like $200,000. It's not going to matter because the seller's not going to sell to me for $200,000. Then I'll look at interest rate. Is there any viability? Okay, it's saying, okay, even as low as 3.5%, it's not viable. I would set this to 0% and say, at $19.79 a month plus these other costs, it's $438 of cash flow, 2% cash on cash return. So at least I know it's positive cash flow. So I got some wiggle room. How can I increase my cash on cash return then? Well, we've already maximized our cash flow for the most part at 0%. You can increase your cash flow by extending the term and going that route, but that's not very likely. Like the seller, they're going to like the $2,000 of payment. They're not going to want like $1,000. They're going to sell this house to finance it at 0%. And then you only give them $1,000 a month. That doesn't really make a lot of sense for them. So then what I would do is say, okay, if I drop the down payment, does that improve? Does that improve the deal or not for me? And we showed that that didn't improve the deal because the effect on cash flow is much more impactful in this scenario than the reduction of entry cost. But I would go, okay, 20%. Nope. 15%. And I would just keep trying it all the way. But once you get cash flow negative, it doesn't work. And it's already showing you the trend is that it's going to go down if you keep reducing that because the impact on the increased payment is much more impactful than the decrease in entry cost. And that's what I would have known immediately. I can't really do anything unless they're open to me buying it at 0%, 60-year term, 10% down. Like if I've got to change everything, the seller's probably not going to do it. So I'm not even going to sit there and waste my time. I could tell like a wholesaler or the seller, hey, I ran my numbers. The only way I can make this work, and I totally get it if this doesn't work for you, 10% down payment, use that to pay off your loan. You seller finance the remaining $855,000. I can pay you up to $1,200 or $1,187 a month. And we can set a balloon at some point in the future to get the full remainder of your price out. Like that's really all you can do. There's not, and that's like you're asking for them to change all their terms. The only thing you're agreeing to is their purchase price. And this is lower than I think what you told me before.
Yeah. So who's coming in to buy this at 989? Somebody that's got FU money? Nobody.
Someone who's maybe they have ulterior motives. So like they have a 1031 exchange and they want to save taxes because they just sold a property. They're going to 1031 into another asset. And they just
Got it.
want to, they don't care as long as it's cash flow positive, then it would make sense for them. And remember, if they have $1 million property or, $1 million of gains or whatever, they're going to save a bunch on taxes and they're not going to have a loan, right? So they're basically going to buy it. Let's say maybe they'll buy it with a 50% down payment. They saved on taxes and their returns, even though the cash on cash return isn't there, they're going to generate solid monthly income and not pay taxes. Someone like that, for the majority of us, this doesn't make a lot of sense.
Got it.
This doesn't make a lot of sense for the majority of us who are either using our own money and are not worried about saving some money on capital gains and taxes. We're focused on growing our portfolio, especially if we're leveraging other people's money. There needs to be solid returns for everyone. Um, mhm. All right, y'all. I appreciate you. Once again, YouTube, Instagram, you're all part of Wealth of Real Estate. If you're watching this on YouTube, you got to be part of Wealth of Real Estate. You're missing out on these live calls if you're not. The recordings are not the same. And then the intentional investor community starts November 1st. If you are serious about buying and holding real estate, ideally using little to none of your own money, you want a step-by-step action plan, blueprint process with all of my systems, tools, and resources, my CRM, literally everything I use to streamline my portfolio growth and everything I'm doing every single day. That's what Intentional Investor is for. I'm opening the doors on my really high ticket mastermind that I do, that boot camp, and I'm making it accessible to everyone. If you are serious about investing in real estate, the return on your investment is like undeniable. If you pay the $500 a month and that's 6,000 a year, you're going to raise 50,000 or more on your very first deal. The return on that, it'd be like 8 years of payments to then equate to what you were just able to raise in capital to buy your deal. And you're going to make sure you're minimizing your risk by thinking through all of this stuff when you're buying deals, because you're also going to master deal analysis. One of my mentees, she just locked up and is about to close on their very first buy and hold property. They have some fix and flip and wholesaling experience, but their very first buy and hold property, a 4 unit, and they raised $139,000 in during the 6 week boot camp. This is literally what I do every single day. The people that I help directly through the higher ticket coaching, they get extreme results, and you can do the exact same at a fraction of the cost. So if it's the right fit for you, if not, no worries. See you in the Wealth of Real Estate community. Thanks, y'all.
Thank you very much, Michael.
Appreciate you guys. Have a great rest of your week. Have a great weekend.